for a beginner, how can they start investing in the stock market?
The first step to investing in the stock market is to get some money in a brokerage account.
How much money do we need to start investing?
You can start doing this process with
The stock market is still considered as gambling, and people are still scared to invest in stock market.
Any endeavor that you want to do, especially when it comes to money. Step one is always,
what is Dow Jones and what is also S&P 500?
the Dow, S&P 500, and NASDAQ are what's known as market indices.
What is a stock?
A stock simply represents
Why does the stock market go up?
buy and hold index funds, do them for long periods of time, and the stock market always goes up.
Can you talk about investing in individual stocks versus index funds?
99% of people should invest in index funds, baskets of stocks. This is the power of compounding interest. It takes forever. It takes a long time to get going. But once it gets up to a big enough size, it's like an automatic wealth creation machine. The dollar price of a single company tells you nothing about the value of that company. The thing that you should be looking at when judging the true value of a company is a concept called the number one reason that companies go public is because they want to
Hello and welcome to the Compounding Project podcast, where we talk about taking small steps to become healthy, wealthy, and wise. I'm your host Satish Gajula, and this episode is all about wealth, especially stock market investing. Our guest today is Brian Feroldi, who's joining us from New England in the US area. Brian is a financial educator, YouTuber, and best-selling author on a mission to demystify the stock market. His work has been featured in CNN, Business Insider, Yahoo Finance, Inc., and many more. Over the years, Brian has written more than 3,000 articles on stocks, investing, and personal finance for The Motley Fool. He's also the author of the best-selling book, Why Does the Stock Market Go Up? His book is a plain English guide that makes the complexities of the stock market simple and accessible for everyone. Today, Brian joins us to share practical tools, tips, and strategies to help you better understand the stock market and, most importantly, take your first step towards investing and achieving financial freedom. With that, Brian, welcome to the show.
Thank you for having me, Satish. Thank you for the nice, warm introduction.
I'm hoping it's going to be all uphill from here. Let's see. I'm going to dive right in. So what got you interested in the stock market?
So I graduated from college in 2004. And despite graduating with a degree in business, I would essentially consider myself to be financially illiterate. And so that's really speaks poorly about the state of education in America, or at least from what I understand around the world, about how little people talk about money and finance and investing. However, when I graduated, my dad, as a graduation gift, gave me a copy of a book called Rich Dad, Poor Dad by Robert Kiyosaki. And I read that book cover to cover in like 72 hours. And that was the first book that ever talked about very simple personal finance concepts, like everybody is in business for themselves. You can build wealth in one generation. The rich think about money differently than the poor do. That book primarily talks about real estate, but that it kickstarted a love affair with investing and growing my money. And as I delved more into the topic, I learned that the stock market and investing in stocks was the asset class that fit my personality best. So it was a slow discovery, trial and error, and looking at the different asset classes that led me to the stocks in the stock market.
Got it. Yeah. I'm sure like Rich Dad Poor Dad is the most like, it started the reading journey for most of the people. Almost like half of the guests that I speak to, they say like Rich Dad Poor Dad changed their life. And of course, it changed my life too, like when it comes to like financial concepts. The first question I asked my wife was, why was I not taught about this in school after reading Rich Dad Poor Dad? That's the first question I asked. Before he hit record, we just talked about this. Like, we want to keep this at a very basic level because especially where I come from, like I'm originally from India, it's still, stock market is still considered as gambling and people are still scared to invest in stock market. Before I ask about all this Dow Jones and S&P 500, can you talk about your story, like the caddy story that you mentioned in your book? Like, Can talk about that story?
Yeah, sure. I think many people growing up like I did are aware that there's a thing called the stock market, have heard terms like Dow Jones, S&P, NASDAQ, and they're aware that those are words that some people think are important, but they have no idea what those terms mean or what they are. And I completely understand why many people look at the stock market as just a giant gambling machine. Because if you're the only way that you look at it or interact with it is you see numbers going up and down seemingly randomly. And people are told to buy and sell and all that kind of stuff. It makes complete sense why it is a gambling machine. And the stock market can be a giant gambling machine if you don't approach it or think about it with the right information and the right mindset. So I vividly remember being a caddy when I was a teenager at this fancy golf course that was nearby when I grew up, and I was caddying for some members during the working day at a tournament. And at the turn, which is after the ninth hole, they all went in for burgers and drinks and all that kind of stuff before we did the back nine. And one guy comes out and he's like, "You're not going to believe this. The Dow is up 300 points today," and like they were all like high-fiving each other and like they were very excited. And I, as the caddy, was like, "I don't know what the Dow is, but I do know that it's good when it goes up, and this can only increase my chances of getting a good tip." So it's just I think a lot of people have experiences similar to that where they come into contact with these words like Dow and S&P 500, but the fact that they're never explained to us in any capacity is truly a travesty.
All right, yeah. So why don't we bust some with like what is Dow Jones and what is also S&P 500?
Yep. So the Dow, S&P 500, and NASDAQ are what's known as market indices. So there are thousands of publicly traded companies out there. Everybody that's listening to this knows many of them. Apple, Microsoft, Meta, Johnson & Johnson, Novo Nordisk. These are companies that their stock, the ownership in those companies is publicly traded, and anybody with money can go out and buy stock in those companies and become a partial shareholder. Now, the trouble was, while there's thousands of companies out there that represent that publicly trade, it's really hard for market commentators or people that invest to get good, accurate data on all of those companies at the same time. So over 100 years ago, the editors of the Wall Street Journal, a guy named Charles Dow, worked with his business partner, a guy named Edward Jones, to come up with a way that they could summarize for their readers what happened in the market that day. And what they did was they decided to add up the stock price of 12 of the largest, most well-known, most widely held publicly traded companies. They added up their stock price and then divided by 12. Now, doing so produced a single number that they called the Dow Jones Industrial Average. And by reporting this number and tracking this number every single day, they could summarize for the readers of the Wall Street Journal what happened in the stock market that day without having to track every single company. So that's all an index is. It's a small number of companies whose price or whose performance is tracked, and that is a representative of what happens for all of the companies in the stock market. And the three best known indices are the Dow Jones Industrial Average, which is the oldest and tracks 30 companies, the S&P 500, which came out in the 1950s and tracks 500 companies, and the NASDAQ Composite, which is the newest of the three and tracks a few thousand companies.
We'll get back to the episode in just a few seconds. 94% of people who watch this channel haven't subscribed. If you're enjoying this episode, can you do me a quick favor and hit that subscribe button? It helps the channel grow and brings in even more guests so that I can provide more value to you in the future episodes. Now, back to the episode. Got it. Yeah, it makes total sense now. So just to get a sense of the market, we have these indices, right? Instead of going through each and every stock to see whether it went up or went down. So we have these indices. It makes total sense now because we, when growing up, at the end of our news channel, we have this just like a couple of minutes about stock market, right? We have this Nifty 50 and Sensex in India, and then I have no idea what that meant. It just said, it went up or it went down, and that's all I knew was like, if it goes up, it's good, and if it goes down, it's bad. That's all I know. So one question that comes up is, let's say, so if the index went up, so it doesn't necessarily mean all the stocks in that index went up, right?
Correct. So let's take the S&P 500 as an example. That's I would argue the best index that's out there. The S&P 500 represents 500 of the largest, most profitable, most well-known companies that are headquartered in the United States. And again, this includes Apple and Microsoft and Meta, et cetera. Well, every single day, all 500 of those companies, their stock price moves. Some of them go up, and some of them go down. And the S&P 500 index takes all of those stock movements of those 500 individual companies. It weighs them by how big the company is. So a multi-trillion-dollar company like Apple has a far greater influence over the index than a really small company does, like a $10 billion company. And then it takes all those movements and it weighs them into a single number. So on any given day, it's fairly typical that some stocks are up and other stocks are down, and the number that gets reported in the news or on the internet is just what is the weighted average result of all those companies together.
Got it. So as we are recording, I think S&P 500 is around close to maybe between 5,500 to 6,000. So does that number matter? Because Dow Jones, when I see Dow Jones, it's like 30,000, 40,000, right? Versus like S&P, which is 5,000, 6,000. So does that number matter, or what do we have to care about?
Does it matter? The answer is both yes and no. It matters to a degree because people have it in their head that bigger numbers are better. And it's very common for people to say things like the Dow fell 300 points on any given day. So from that perspective, since humans are naturally designed to think bigger numbers equals more important, it matters. In reality, the number of points that an index increases or decreases is basically an irrelevant figure. The number that actually matters is how much it changed on a percentage basis. So let me give you a quick example. Let's say one index, the value is 100,000, and another index, the value is 1,000, okay? If that 100,000 index increases by 1,000 points, that sounds like a lot, but that's just a 1% move. If you go to that 1,000 index, that the whole index is worth 1,000, and it increases by 10 points, that sounds like a little, but that's also a 1% move. So it's the percentage change that matters the most and should be the only thing that investors care about. But humans, especially those that don't know what the index is, look at the point value and they assign more value to a bigger number. But to answer your question, it's the percentage that matters, not the points.
Wow. Yeah, I learned this from your book, why does the stock market always go up? And then it made perfect sense now, because I'm wired that way, right? I mean, big numbers, big returns, or, big losses. But yeah, that's one myth that we demystified. So I know we touched upon it, but let's even get to the basic level, like what is a stock?
Great question. Incredibly important thing to know and to understand. At its core, a stock simply represents fractional ownership of a corporation. Really simple analogy to think about that. How do we keep track of who owns real estate, like a house and a parcel of land? The answer is a thing called a deed. A deed is a legal document that says this person owns this piece of real estate and this land in a ledger. So deeds are a way of tracking ownership of real estate. In investing, same exact concept, but instead of calling it a deed, we call it a stock. Now, what's different is that while there's typically one owner of real estate, there can be hundreds, thousands, or millions of owners of corporations. So when a company is formed, It chooses how many shares of stock that it has. Some could choose 1,000, some could choose 1,000,000, others could choose 1,000,000,000. It is completely up to the company to choose the number of shares that it has. And then the investors in that company buy the stock from that company, and they own or have a claim on a portion of that company's assets and future profits forever. So that's all stocks are. They're a record-keeping tool for figuring out who owns how much of a corporation.
So basically, like when we are buying an Apple stock, we actually are a fractional owner. It could be in a like minuscule amount, like in terms of percentages, but still like we're a fractional owner of the company. That makes total sense. So maybe I'll take a step back and also want you mentioned shares, like company can have like 1,000 shares or 100,000 shares, right? So why does a company want to issue the shares? Like, why do they want to go public? Can you talk about that?
Yep, absolutely. So when it comes to issuing shares, companies tend to have investors, the owners of the business. They put capital into the business to get it started. And in exchange for giving the company capital, they receive ownership or equity in that company through shares. Now, companies can have different capital needs at different periods of time. It's very common for companies, especially startups, to have desire to spend more money than they have in the bank. And one way that they raise capital or grow their bank balance is by issuing new shares of stock. They can do so privately, like they do with venture capitalists, for example, or they can do so publicly. And when a company wants to raise capital and be a publicly traded stock, it does this thing called an initial public offering, or IPO. This is when a company works directly with investment banks like Goldman Sachs or Bank of America or Morgan Stanley, and it takes its stock and it transitions from being a privately held company to a publicly held company. Most companies that go through that process create brand new shares of stock, brand new ownership in them, and they sell those shares to the public markets. And in doing so, they receive a huge injection of cash based on how many shares they sell and the price that they receive per share. So there are a few reasons that companies can become publicly traded, but the number one reason that companies go public is because they want to raise cash that they can invest in the business to grow.
Got it. Okay, that makes perfect sense. One immediate question that comes up to my mind is, let's say when they go, you mentioned IPO, initial public offering. So does like 100% of company is actually issued to others? Like, do they keep a portion of, let's say 50% with their original investors, and then 50% will go to the public?
Yes, the ratio of shares that are publicly traded to privately held is different for every single company. Some companies, especially those that are run by their founders, oftentimes the founders or the venture capitalists can often have a huge percent of the stock owned by them individually, and they can only sell a small amount of the stock publicly. Other companies are diversified in their ownership, and they can have a lot of stock sold to the public. It's typically dependent on what is the value of the company at the time that they go public, and how much money are they trying to raise. As an example, let's say a company is worth $1 billion and it wants to raise $500 million. Well, it's going to be basically issuing 50% of its shares outstanding to get that $500 million. Conversely, if that company is worth $1 billion and it only needed to raise $50 million, it would just issue 5% new shares outstanding. So that ratio is totally dependent from company to company, and it very much depends on the business and the ownership before going public.
Now I understood like why actually the market goes public, and also like, so you mentioned like one of the main reasons could be just to raise money. Yeah, that could be so. Can we talk about you mentioned share, like we heard about this share price, like initial public offering. There's a price. So how do they even come up with the price, and does it matter?
Yes, the dollar price that a stock issued at, this is another thing similar to the points value that we talked about with the indexes, that both matters and does not matter at the same time. Humans are naturally designed to look at the dollar price of an item and attribute the value of expensive or cheap to it. In investing, you can't make that correlation. A stock could trade at $500 per share and be cheap, and another company stock could trade at $2 per share and be insanely expensive. So that's a correlation that you just have to get out of your mind when you're investing. Having said that, most companies that come public, but not all, tend to want their stock priced somewhere between $10 per share and $50 per share. Not all, but that's generally the range that companies try to aim for. So the number of shares that they choose to have outstanding, the number of total shares of the company, and the number of shares that they issue, Wall Street typically sets those parameters up so that the share price is in between that range. There are companies that come public in the multiple $100s per share, and there are companies that come public and their stock price is pennies per share. But the relationship between those things has no bearing on the value of the company or how important the business is or if it's cheap or expensive. So you need to get that correlation out of your mind if you're going to be investing, which is very hard to do.
Got it. So can you talk about the value of the company? So how do we calculate the value of the company?
So that's a complicated question that requires more nuance, but as a very general statement, the value of a company, the academic definition of the value of the company is the present value of the company's future cash flow. So what a business is worth, academically speaking, is you calculate how much cash that company's going to generate over its lifetime, and then you discount all of that cash back to today's value, and that gives you the present value of the business. That's the academic answer. The real answer is what investors are willing to pay for that business. There are companies out there that can have multi-billion or multi-hundred billion dollar valuations and have no revenue today. There are also companies out there that can have tens of billion dollars in revenue and still only be worth a few $100 million or some very small amount. So valuation is a very complicated thing, but there's an academic definition and then there's like the real world definition.
It is like when it comes to market capitalization, can you talk about it? Like, we have this outstanding shares and we have a share price. So can you talk about like how what's actually a market capitalization?
Yeah, absolutely. So we talked before about how the dollar price of a single company tells you nothing about the value of that company. The thing that you should be looking at when judging the true value of a company is a concept called market capitalization. Market capitalization is a simple formula, and you can look it up on any publicly traded, any public website that tracks stocks. The formula is what is the current price of one share of stock times the total number of shares that are outstanding. As an example, let's say a stock is currently trading at $50 per share, and there's 1 billion shares of stock in total. 50 times 1 billion, that would give that company a market cap of $50 billion. And what that represents is what is the equity value, the value of the ownership in that business of that particular company. Said differently, if you wanted to acquire that entire business at its current price, it would cost you $50 billion to do so. Learning to focus on market capitalization is what every investor should do because that is the true value of the business. So since the share price is a component of that, but it includes all of the shares that are outstanding, it's far more accurate to look at market capitalization as opposed to just focusing on the price of a single share.
Yeah, now it makes sense. Like, Tesla's price, right? We saw it went up to like $1,000, and then we thought, okay, that's, it's an expensive company. But again, like, yeah, when we look at the market capitalization, that's when we understand the example that you mentioned, like $50 billion. So that's when we understand the value of the company. So one other question that comes up is, when it comes to IPO, right? So if they want to raise money, they would issue the shares and then it is at a share price. And so when does the company get money? Only at the IPO stage or when the stocks are traded on the market also?
Yep. So a company typically, when it comes public, it issues new shares of stock and it sells those shares to the market and it receives a cash infusion. That's the initial public offering. And that is typically, for many companies, the only time that they raise money from the public equity markets, but not all. Now, once a company has its stock that is publicly traded, it can at any time issue more shares of stock to the public market if it wants to raise additional capital. This is a benefit of being a publicly traded company, is that you can tell based on your share price how much capital you could raise and what the dilution rate would be at any given time. So while many companies have the ability to issue shares and raise capital, it's far more common for companies to raise capital once, just at the initial public offering, and not again. But they could issue even more shares of stock whenever they like, and raise capital for themselves.
So the company gets money only when it's in the initial public offering, but when it's traded on the stock market, on a day-to-day basis, it goes up and down, right? Does a company make money?
Yeah, very confusing thing, right? This is something that I heard from my friends. Like, so if I buy shares in Apple, does Apple get the money? The answer is no. So Apple, when it came public, sold shares of itself to the public market back in the 1980s, and it got capital from investors from doing so. Once Apple sells the shares, they're no longer owned by Apple. They're owned by another investor. Could be a pension fund, could be a hedge fund, could be an individual investor, could be another corporation. Somebody owns those shares in Apple, and that is not Apple. So when you see shares being traded on a public market, what's happening is one investor is selling shares in Apple to another investor. And the company itself is not involved with or does not benefit from that transaction at all. So if I go out and I buy shares of Microsoft, the money that I'm spending on the shares is not going to Microsoft. It's going to the investor that owns Microsoft stock, and it's selling it to me.
We have so far 30 minutes of recording. I wish I had known this 10 years ago, so that I would understand a lot about stock market, because it's so confusing. And then now when you mention all these concepts, it looks so evident, it's so obvious now that all these concepts. Yeah, we talked about stock market and IPO. So why actually the stock market, or the stock of a company, the stock price goes up and down? Why does it go up and down?
Yeah, so this is another thing that there is the multiple answers to, but by and large, think of the stock market, the public stock market, as an ongoing, live, continuously updated auction. If you've ever been to an auction before, or part of it, and if I said, why does the value of the asset, the thing that's being bid on, go up at an auction? Everybody understands. There's buyers, and then there's the auctioneer, and the auctioneer is calling off prices, right? $100, $110, $120, and it's trying to, the price is increasing until there are no more buyers for that asset, and that is the final price. That's exactly what's happening in the stock market. What you are seeing any given second with a company's stock is the exact price. The current market price is the lowest price that a seller is willing to sell at, meeting with the highest price that a buyer is willing to pay. And those two factors have different amounts of supply and demand to them. Let's say a stock is trading at $100 per share. Somewhere out there, there's a seller that's saying, I would happily sell my stock on the public markets if the price was $100.10 per share. And so that they could have a sell order saying, I'll sell this stock if it goes up to 110. And conversely, there's buyers out there saying, I would happily buy this stock if it traded for $99.90. And it's the eagerness or the willingness of the buyers and the sellers at the market price to lower or increase their bids that sets the market price. So it's really the price of a company stock is determined by the eagerness of the sellers to sell, combined with the eagerness of the buyers to buy at any given time. So that's why all day long, there's little changes in the company's stock price up and down. They're randomly basically measuring the eagerness of the seller and the eagerness of the buyer. And on occasion, there are large moves in the stock price based on like company news. And that could, if that news comes along and it's good, all things held equally, the stock price will rise because sellers are no longer willing to sell at that low price and buyers really want the stock. And the inverse is also true. If bad news comes along, sellers want out and buyers only want in at a much lower price. So this is why stock prices fluctuate ever so slightly all day long during public hours. It's a constant battle between the sellers of the stock and the buyers of the stock.
That's very, very interesting. So when the company share price goes up and down, does anything happen to the company itself, or it's just in the market?
So as a company's share price is increasing or decreasing, the market capitalization of the company is also increasing and decreasing. Remember that market capitalization is stock price right now times number of shares outstanding. So if the stock price goes up, the value of the company's equity goes up. Stock price goes down, the value of the company's equity goes down. For most companies, they're not too concerned with the value of their equity. The companies are concerned with the value of their equity if they want to sell their stock, in which case they want the value of the equity to go up, or they're going to be buying back their own stock, in which case they want the value of the equity to go down. Now, that's the, again, academic definition. In reality, no manager or CEO of a company wants their stock price to go down, because that reflects basically on how they are doing as a manager. And if a company's stock price goes down and it stays down, the shareholders of that company, aka the owners, get very unhappy with the manager of that company. And sometimes they will even go to drastic extremes to fire the CEO and replace them with somebody new. So CEOs of companies want their stock price to go up so that they can maintain their job in many cases. So it does impact them in that way. But unless a company is selling stock or buying it back, they're largely ambivalent to the dollar price of their stock.
Now I'll ask like the most controversial question. You said, the stock market always goes up, right? So can we talk about like why does the stock market go up? Can you walk us through an example?
Well, so I literally wrote a whole book because it's a fairly nuanced thing, but my entire goal for the book was to answer that question. I myself have been investing for years. I'm a huge consumer of financial products and media, and a lot of the books that I read when I first started investing all said the same thing. Buy and hold index funds, do them for long periods of time, and the stock market always goes up. And if you look back historically, it's absolutely true, at least in the United States, where the stock market continually goes up and continually makes new highs. What was never explained to me was why that happens. What is the thing that causes the stock market to increase in value over time? At its core, the answer to that question is that the stock market represents ownership in businesses, and businesses are valued based on their current and future profits. So the reason that the stock market goes up over time is because the businesses inside the stock market, in the indexes that we talked about previously, increase their profitability over time. Businesses in the United States have increased their profits consistently ever since the country was founded, essentially. And there's a number of underlying forces that allow businesses to do that and increase their profits. So as long as corporations continue to increase their profits over time, investors should have confidence that the stock market in the United States will continue to go up over time. So that is the thing that you should focus on if you're an investor. Business profits. Although that is rarely reported in the news and certainly not talked about when they're summarizing the market's actions.
When it's about business profits, we have all heard about companies like Enron, and there are other companies, they go bankrupt, right? So we have a fear that what if you buy a company and if it goes bankrupt, which means like the market doesn't always go up. So there are companies, which are going bankrupt as well. So can you talk about that one?
Yeah, absolutely. I have investors in my life, and I tell them I own individual stocks, and they have a fear that stock will go to zero. They're like, I don't want the company to go to I don't want my investment to go to zero. If you don't want your investment to go to zero, don't buy companies that could go to zero. There are plenty of companies out there that it would be impossible for them to go to zero. What do I mean by that? How does a company go bankrupt? The answer is it can't pay its debts. It owes interest payments to others, and its business can no longer support those interest payments. But if a company has no debt, it is impossible for that company to go bankrupt. It can be a terrible business, but if a company does not have debt and it is not losing money, so it's not dwindling its cash supply, that company cannot go bankrupt. The same way that if you own your house outright, if you have 100% ownership in your house, you have no debt, no mortgage on your house, your house is not going to be taken away from you if you're not making interest payments, because you don't owe anybody anything on your house. So the same concept applies to a company. So let's take Facebook as an example, or Meta Platforms, whatever their name is now. Meta Platforms has zero debt, and it has something like $50 billion in cash. It is literally impossible for Facebook to go to bankrupt because they have $50 billion in cash and zero debt to their name. Now, Facebook stock could go down a whole lot. It could go down drastically for a variety of reasons if the company's profits were permanently impaired. So you can lose money by buying Facebook stock, but Facebook can't go to zero in its current state. For it to go to zero, it would have to go bankrupt, and to go bankrupt would require it to issue a lot of debt and to get rid of all of its cash. Now, if Facebook was horrendously managed over the next couple of years, that could possibly happen. But this is why it's very important to understand the fundamentals of stocks and stocks, how they work, because it's a completely rational fear to be like, I don't want to buy this thing and have it go to zero. But once you understand the core principles behind the stocks and the stock markets, you realize that is just an irrational fear.
Yeah, so that's just one company. Let's say if you're not talking about bankruptcy, but at least like if the profits are decreasing over time, so which means let's say the profits of all companies in the market are decreasing over time, which means the stock market doesn't always go up. Like that's a possibility, right? So yeah. So can you talk about why the market goes up or long term?
Yep.
Let's like why.
So let's take COVID during an example. During COVID, when essentially the world economy got shut down, a whole bunch of business profits went very south very fast, right? Unemployment skyrocketed. There were layoffs everywhere. There was business corporate profits went down, and the stock market in the United States had its biggest bear market in history. I think it went down 30-something% in the matter of 6 weeks or so, and then it immediately rebounded. So there's the difference between a company going to zero and a stock index going to zero. For the stock index to go to zero, all of the companies that make up that index would collectively have to go to zero. But to your point, the stock market has gone up over time because business profits have gone up over time. If there was a scenario when business profits were permanently plateaued and they were in a permanent state of decline where they were going down, then the value of the companies in that index would also be in a permanent state of decline and going down. I have a very hard time seeing that happen, given the factors that drive corporate corporations to go up in the long term, and the market also thinks in typically multiple year periods. So even if profits temporarily declined, as they did during COVID, the market does take a longer term view, and it says, well, yes, profits are down now, but they're going to snap back once this crisis is over. But to answer your question, if market profits were in a permanent state of decline, then the stock market would also be in a permanent state of decline.
But is that a possibility for it to happen? Let's say over long term, right? Maybe 5 years, 10 years, or 20 years down the line, can the market have this permanent decline of profits? Because I'm a long term investor as well. The only fear that I have is, what if all the market decline and then it never rebounds? Like, can you talk about that?
Absolutely, that could happen in the event of like nuclear war, a global nuclear war, when populations and around the world are just decimated. In the event of like an asteroid striking the Earth, and people getting wiped out, alien invasion, a supernova, super volcano. There are plenty of extinction level or species level threats that we could face that, if they happened, could cause the population to decline and business profits to decline. Absolutely. In the event that those happen, the least of our concerns would be the value of our portfolios, right? We would be concerned with survival, not the stock portfolio. So that would be horrendously bad for humanity. But if all business profits everywhere declined, is likely to be the least of our problems.
Got it. Makes sense. When that happens, like we'll be focusing more on getting our next meal
Yes.
versus what's happening to our
Yes.
share price.
Totally. So could it happen? Absolutely. But if it does, that's not our biggest problem.
Exactly. Yeah. Now I'm actually much confident about now understood like why the market actually goes up. Basically, our future generations will have a better life than us, and then which means that the productivity increases over time, and the businesses they want to like make profits, right? And then overall the economy goes up, and which means the stock market goes up in the long term. So can we talk about stocks itself? When I started investing like 10 years ago, and at that time my major friction was, what if I buy a stock and if it goes down? But I've read books and then they all talk about a different concept like index funds and all that stuff. So can you talk about investing in individual stocks versus index funds?
Yep. So as a general statement, 99% of people should invest in index funds, baskets of stocks. If they don't have the time, or most importantly, the inclination to learn how to research an individual business themselves, which again, my experience, 99% of people do not, no problem. Just buy an entire index fund like the S&P 500 or the Vanguard Total Stock Market Index Fund. These are hugely diversified, extremely low cost, extremely tax efficient ways to get money in the markets and generating wealth for you as an investor. But if you're in that weird 1% of people that actually enjoys researching businesses, actually enjoys analyzing stocks, and actually enjoys watching the markets, then you are 100% the right type of person for investing in individual stocks. But you have to have the interest and the inclination to learn how to invest the right way, which in my experience, most people do not.
All right. So I've been, I've loved. I mean, I'm a my almost like 90% of my money is in VTSX. I love that fund. And I've been recommending my friends to buy in index funds almost like for a decade, right? And then the most obvious question that I always get is why. So VTSX on an average is like 9 to 10% per year, and my friends say, okay, I can get more. Right? Why would I want to stick to the average like 10% per year when I can double my money in 1 year or 3 years or 5 years? So how do I respond to them?
Sure, they could get lucky. They could invest in the right stocks, and they could outperform the index. That's entirely possible to do so. If unfortunately the math is against them. If you look at studies by like J.P. Morgan, they've done analysis on how individual investors do compared to the market, and by and large, as a general statement, individual investors underperform the market because they overestimate their ability to invest. They overestimate their ability to invest well. And we can say it's very easy to say Warren Buffett does this, or it's very easy to say when the market goes down, I'm going to invest more, or when the market's in free fall, I'm not going to panic sell. It's very easy to say that. It's very hard to do that because we are social creatures and we naturally take our cues from what we see from others. So if we see people around us panicking and in a frenzy and selling their stocks, it's extraordinarily difficult for most people to not also panic and to actually want to go into a buy mode. Conversely, if we see stocks going up, people are making money and they're talking about it online, it's very hard for individual investors to say, I'm not going to do that. Markets are overvalued right now, and to watch other people get rich. If you have that intrinsic ability to you, and you're one of those people that can do what the crowd doesn't do, then you are cut out to be an individual investor. But I would advise anybody that's interested in that to just do a simple experiment. Put 90% of your money into index funds, VTSAX, whatever, and then take 10% of your money and invest it however you see fit. Do that for 5 years and then measure the results. How did I do compared to the index? And if you lost to the index, go with the index. If you beat the index, take more of the money that you invested on your own and put it on your individual side. So, and then I will also say to people that are trying to double or triple their money in 1 year or 2 years or 3 years, your mindset is incorrect. You have traders and gambling. You're trying to gamble. The only way to earn a return that is that high is to take extreme risk or get extremely lucky. And if you're investing in stocks with a short-term mentality, you are going to get burned badly.
Counter statement that I would give my friends is, okay, I mean, you can double your money in 1 year. Just try running that calculation over a 20 or 30 period of time, right? Just do the math. If you double your money in 1 year and do the math, and then it will explode, right? The numbers will explode when you do that on an Excel sheet. Like we can, I mean, maybe just like you said, we can, out of luck, we can do it in 1 year, but can we do that consistently over a long period of time? And it's very hard. So you're talking about this comparison, in individual stocks performance versus index fund performance. I believe Warren Buffett had a similar bet. I think in 2008 he has his bet. Can you talk about that bet?
Yeah, so Warren Buffett has long railed against the high fees that hedge fund pays. So he made a bet with anybody out there. He said, "I will bet you $1 million that you can take over a 10-year period. You can pick whatever hedge funds you want. You can put your money into any hedge funds you want. I'm going to invest in the S&P 500 or broad-based index funds, and over 10 years, I bet that my returns are higher than yours." And he put $1 million up. Well, a portfolio manager named Ted Seides took him up on that bet, and Ted invested in a fund of funds, so like multiple different hedge funds. And they started in 2007, I believe, 2007 or 2008. And initially, what came next was the great financial crisis, when the entire market fell by like 50%. The hedge funds that Ted Seides invested in were down very, very, very little, like 20% or 25%, far ahead, blowing past the returns of the index. However, if you played out what happened moving forward, the hedge funds dramatically underperformed the index over a long period of time, partially because they were too conservative with their money, but also because of their high fees. And over the 10-year period, the index fund blew away the returns of the hedge funds, and Warren Buffett won. This is why in Warren Buffett's own will, his instructions to his family, he said, "My instructions couldn't be simpler. Take 90% of the money, put it in the S&P 500, take 10%, put it in short-term treasuries. Your capital allocation is done for the rest of your life." And if that's Warren Buffett saying that, I have a hard time improving upon that advice myself.
That's very well illustrated. I mean, the first time I read this in a shareholder letter, I was actually tracking the expenses. He has this table where, year 1, year 2, and or like 10-year period, and hedge funds couldn't even come close for a 10-year period. And I was like, they're designed, like there are smart investors who are actually fund managers, who are actually making these moves, and they must have gotten this like fancy degrees, and that's what they do for their living, and then they still can't beat the market. And who are we, right? So that comes to my mind all the time. So yeah, you mentioned like fees and stuff. So now I think we have established the foundation when it comes to like stock market and stock market investing, and also individual stocks versus index funds. So for a beginner, how can they start investing in the stock market?
It's extremely simple. Investors today are so spoiled. The first step to investing in the stock market is to get some money in a brokerage account. We've heard of many of them. They're all over the world, but there's Robinhood, Fidelity, Schwab, Vanguard. There are lots of high quality brokers out there. So you open up a brokerage account the exact same way that you would open up a bank account or a checking account. That's step one. Step two is to put money into that account. So transfer money from your checking account or your savings account into your brokerage account. Step three is to take the money that's in your brokerage account and buy investments with them. Now, there are multiple ways to do so. The easiest way that I like to recommend is just by buying exchange traded funds, or ETFs. There are lots of index funds out there that are extremely low cost, very easy to set up, and very easy to do. Some of the most popular ones out there is an exchange traded fund called the SPY, which is just the S&P 500. Another one is called the VT, or Vanguard Total Stock Market Index Fund. Another is called VOO, which is another S&P 500 tracker. You should go with the one that is the lowest cost and put money into that. Brokers will also help you set up automatic investment plans so that it takes money out of your account on a regular basis, weekly, biweekly, monthly, every pay period. Set that up and automatically transfer money into the account and buy those index funds on an automated basis. This takes 10 minutes to set up once. And then once it's set, you just let it run on autopilot for a couple of decades. And if you do that, and America continues to prosper, or the world continues to prosper, you will have built a magnificent portfolio that will pay for your retirement, easily. And the faster if you want to build wealth faster, no problem. Just put more money into the index funds on a consistent basis. That is the best way to dramatically speed up the process, is simply by investing more.
So yeah, that's an actionable advice right there. We have our ticker symbols for the fund that we want to invest in, at least for the beginners, right? So the other thing is, when it comes to investing, beginners feel like it's only for rich people. I don't have enough money to invest. So how much money do we need to start investing?
Very, very little. You can start doing this process with like $10 per month. There are brokers out there like Robinhood in the United States that literally it's $0 to set up an account. It's $0 to trade, and you can buy things called fractional shares. So they make it incredibly low cost and incredibly easy. If you rewind the clock 20 years, you absolutely had an excuse to say, I don't have enough money to invest. You would need at least a few $100s to make buying and selling worthwhile, given the fees and the transactions. But nowadays, it is frictionless and costless to set up that process. So there's no excuse. You can probably do it for as little as $1 a month, would be my guess. But I suggest doing as much as you possibly can.
Got it. Okay. Now, I mean, people listening to this episode, I hope they understood the concepts and also take that first step of action. So one thing I want to talk about before I go to the last segment, Hotseat Questions, is compounding. So can you? I almost feel like, I mean, you mentioned $100 per month, or very few dollars per month, but if you do that for decades, right, 10 years, 20 years, it'll go into this huge chunk of money, and it feels like it's too good to be true, and it's very hard to believe. What's happening in the background that actually makes us, have this humongous chunk of money?
This would be compound interest, which Albert Einstein called the eighth number of the world. The idea here is that the interest that you're earning, or the return that you're getting, is also earning a return, that's also earning a return, etc. And this is how the stock market works. The stock market compounds your return over time. One of the things we talked about at the top of the episode was that you shouldn't look at the points that the index delivers. You should look at the percentage that the index delivers over time. Historically speaking, the S&P 500 has returned right around 10% on an annualized basis over the last 200 years. So the market will compound your wealth, historically has compounded your wealth at about a 10% annualized return. So if you invest $1,000, the next year you'll have $1,100, and the year after that you'll have $1,100 plus 10% of 1,100, not just 10% of 1,000. So that $100 in return that you generated an extra $10 the next year. And then that happens again and again and again for each year that you invest. And that is the real gift that generates huge returns for investors over time. It's the compound interest. As a very simple thought experiment, Warren Buffett, his net worth is like $200 billion or something. Let's just say $100 billion to make the math easy. If Warren Buffett gets a 10% return on his $100 billion, that's $10 billion in net worth that he adds in a single year, simply because his starting value is so huge. And if you chart out Warren Buffett's net worth over time, something like 95% of Warren Buffett's net worth was generated after he turned 65. So this is the power of compounding interest. It takes forever. It takes a long time to get going. But once it gets up to a big enough size, it's like an automatic wealth creation machine.
Yeah, that's the theme of the whole podcast here, like compounding. I was the first time I heard about it, I couldn't believe it. I actually pulled up an Excel sheet and did the math, and it blew my mind. Like, I totally blew my mind. And then for people who are listening to this, just there are online calculators out there, but just try what Brian told. Just try to have maybe $100 per month or $500 per month, and then try to compound that at a 10% average return over a 10, 20, 30 years period of time, and it will blow your mind for sure. Yep. All right. I know we have a ton to talk about, but I want to keep this at a basic level. I hope this adds value to people, and they learn a lot. I hope we'll do a part 2 as well, just to talk about all the other stuff when it comes to dollar cost averaging and all the other concepts. So we're getting towards the end of the podcast, and there's this last segment which I call the Hotseat Questions. The 3 questions I ask all my guests. So the first one is regarding action. So we have discussed about a ton of stuff today, and there are so many actions that can come after this episode. So what compounding project is all about, taking that first step of action. So what one small action would you recommend people take right after listening to this episode?
Step 1 to me, to any endeavor that you want to do, especially when it comes to money, step 1 is always educate yourself. Educate yourself. If you want to learn how to build wealth, step 1 is figuring out how you do. And investors today are incredibly spoiled. No matter what your preferred medium for learning is, you can learn on that medium. You like watching videos? YouTube is filled with content about investing. Like podcasts, the podcast world are filled with podcasts just like this one that can teach you how to invest. Do you prefer text? You can go on Twitter or LinkedIn or Instagram, and you can learn any skill that you want. But before you make that investment, before you put your money on the line, step 1 is to always start by educating yourself.
The knowledge out there is abundant for sure. And this second question is regarding books. So books are an integral part of the compounding project journey. So what 3 books would you recommend in 3 areas of life? 1 book on health, 1 book on wealth, and 1 book on wisdom or self-help.
So for health, I'll go with Outlive by Dr. Peter Attia. I'm a huge fan of longevity research, and I love that people out there are doing research on that. On wealth, I'll go with Your Money or Your Life by Vicki Robbins. That was a book that kind of opened my mind to the power of investing and just gave me a new method of thinking about money. And when it comes to wisdom, I'll go with Poor Charlie's Almanac, which is documents kind of the wit and wisdom of Charlie Munger, Warren Buffett's right-hand man.
Yeah, I have physical copies of all the 3 books that you had mentioned, and then Outlive and Poor Charlie's Almanac keep coming very often on this podcast when it comes to book recommendations. But yeah, there's the great books. I'm going to link them in the show notes. Have a rapid fire. I'll give you 2 options. Let me know which comes to your mind. The first one, stock market or real estate?
Stock market.
And I know the answer to this one. Index funds or individual stocks?
Individual stocks for me, index funds for people that don't care.
Right. Buying or renting a house?
Buying.
Time or money?
Time.
The last one, health or wealth?
Health.
All right. Yeah. With that, Brian, thanks for being on the podcast. It's been a pleasure to have you on the show. How can people learn more about you?
Yep, you can connect me on basically any social platform that you're out there on. I'm on LinkedIn, I'm on Twitter, I'm on X. So just search my name, Brian Feroldi.
All right. Yeah, I'm going to link all of them in the show notes. Please do check out his book, Why the stock market always goes up. It's an interesting read. I finished over a weekend, and it's at a 5th grade level that anybody can understand. I read from cover to cover. I'm going to read it again for sure. With that, great. If you found value in this episode, then please don't forget to subscribe. So until next time, trust compounding and take action now. Thank you so much for watching or listening. If you enjoyed this episode, can you do me a quick favor and hit that subscribe button? If you like this episode, then you might enjoy this episode, which links in with some of the stuff we talked today. Thanks for watching. I'll see you next time.